Okay. Accounting equation. So show the effect of the following credit sales transactions on the accounting equation. So I'm just going to do reason. Yeah, I'm going to say effect. And then reason, I'm going to say account debit or credit. I'm just changing it up a little bit, so it looks a bit more like the ones that you guys get. Okay, so sell goods on credit to Mr. Botha, 3,250, and then they give you the cost price. So that means that Mr. Botha owes you more money. Therefore, you have more assets, so plus 3,250, because this debtor now owes you more money. So debtors control debit, right? Which means that you have more income because of the sale. So plus 3,250 for your sales that is now increasing with a credit. No liabilities affected. But you know that you cannot have sales without the goods actually leaving your business in the form of a cost of sales expense. So goods leaving, your trading stock is leaving your business. So trading stock gets a credit, right? Which means that you now have more expenses, therefore less profit. Cost of sales gets a debit and no liabilities affected. Then number 2 says you issued an invoice valued at 4,500. So if the invoice is 4,500, it means that that is your selling price, okay? And it was sold at a profit of 20% that was added onto the cost. Remember that cost is always 100%. Therefore, your selling price is equal to 120% in this specific example. So you have more debtors because this debtor now owes you more money. So debtors control gets a debit. Because you have more sales, so more income, sales gets a credit. No liabilities affected there. But you cannot have sales without trading stock leaving your business, so credit for trading stock, in the form of a cost of sales expense that is now increasing with a debit. No liabilities affected there. The amount is, you started with 4,500 sales. You want cost, so you want the 100. You have the sales, the 120. So 3,750 minus for trading stock, because you don't have that stock anymore. It is now an expense, therefore minus for owner's equity. The last one, the trading stock reduced with 2,000 Rand after someone bought goods from you on credit. In other words, your cost price, the trading stock reduced. You no longer have that trading stock because it left your business when you sold the goods. Therefore, that is your cost price. So you have a minus 2,000 Rand for trading stock. Trading stock, credit. You don't have the stock because you sold the stock. Therefore, it is a cost of sales expense that increased with a debit. No liabilities affected. Why did it leave your business? Because it was a credit sale, so debtors control gets a debit because he owes you more money because of this new sales with a credit that it's increasing with. It was sold at a markup of 50%. Your cost is 100. You want the selling price. Selling price is 150. Cost is 100. So 3,000 Rand plus 3,000 for debtors plus 3,000 for your sales. And that is it.